Hello, Almus Market Mornings listeners. This is Shikhar Garg, your host, bringing you your daily dose of financial update. Today, we have JK bringing in the commentary for you while we see that Brent has touched $130 per barrel. USD index is above 99. Euro GBP crashed. Commodities rose significantly, be it nickel, aluminium, wheat for that matter. Now, JK, what's going on exactly? What is the geopolitical status? Can you just elaborate a bit more? Also, what would be the impact if the $5 million per day, 5 million barrels per day of Russian oil faces ban? Where will oil prices go in this kind of scenario? Please elaborate.
Hey, good morning, Shikhar. Uh, yes, see, normally we study trends in the market before planning any action. And now actually it's the time when we have to assess the trend in the negative headlines, which seems to be having a strong momentum. And anyone assuming a contrary is simply steamrolled. Weekend headlines of Putin threatening statehood of Ukraine, considering any decision to declare a no-fly zone as inciting wider war, and likening the withering sanctions imposed on his country to a declaration of war. We have threats to Iran nuclear deal going through unless US meets Russian demands, and the US State Department asking Americans to leave Russia. Not surprisingly, oil had another 15% surge, with Brent hitting a high of 139.13, just shy of 2008 high of 147.50. This is even as US authorities continue to talk with their allies to ban Russian oil import, which, if done, will put the oil price in an uncharted territory with huge ramifications for inflation in general and for import-dependent countries like India in particular. If countries resort to demand curbing measures, as was done in the past, growth will take a hit. High inflation and slowing growth is the perfect recipe for stagflation, which is the worst environment for investors. These are not normal times for the markets, and most have been ill prepared for the turn of events in the last 2 weeks. Hence, de-risking has been the mantra for investors, and that is seeking safe haven gold for a rise of 6% in this period. But it must still be just the start of a much larger move if we have a confirmed move about 2000 psychological mark. The other safe haven has been US Treasuries, where yields have fallen more than 35 basis points, even as Powell confirms that rate rises will start this month. German bonds, which is the next best place for safety for investors, has seen yields fall to negative territory once again, from 0.33 positive to minus 0.1. Gravity of risk can be assessed from the fact that these moves are happening despite US data showing very strong job numbers on February. On the other side, we have Euro losing nearly 5% during this period, quite expectedly, as they are in close proximity to the war, and impact on their economy is big due to dependence on Russian oil and gas. Any sanction against these commodities will only worsen the hit to their economy. We have reached crucial levels near 1.08 on the long-term charts for the euro, and a clear breakdown from these levels portends much larger fall as stop losses will kick in. However, I feel there is a good possibility of European Central Bank getting into that through direct intervention to demonstrate the stability of Eurozone. Broadly, the dollar has been uh, steady against many other currencies, only with the euro and GBP taking a big hit, and the Eastern European country currencies also weakening. The emerging market currencies have been stable so far, but that seems to be changing now. We've seen some of the Asian currencies weakening, and rupee is likely to follow the same. There are also reports that liquidity issue is emerging in the dollar funding market. So we see the rupee opening much higher than the 2-year range between 73.5 and 76.5, and very likely we see a test of 77 immediately. However, we are also in a stage where strong intervention from various central banks, including India, is very likely, as they would like to avoid a currency crisis adding to the current turmoil. Rupee's direction remains more weakness, but targets will be moving according to evolving geopolitical news. Of course, any sign of situation improving, we are likely to see sharp reversal in all asset classes, but that is too far. We just keep an eye on the peace moves, or rather the discussions that are initiated with Israeli Prime Minister and the Russian leader. So keep our fingers crossed. Thank you.
Okay, all right, JK, that was quite insightful. And we do see that the 210 gap for the treasury yields have also narrowed quite significantly, which is one of the most followed indicators for recession. So keep tracking the markets. Uncharted territory, oil prices will further hurt all the trading deficits, and inflation will keep shooting higher, guys. Like JK mentioned, it's time for de-risking. So hope you guys continue to follow risk management quite diligently. That's it for today, guys. We take another session tomorrow with further more updates. Till then, goodbye.